Welcome everyone. Money Show is pleased to welcome Dr. Joseph Belmonte, founder of Buffett and Beyond Research. He's the world's foremost expert on continuing research and practical application of a financial research model known as clean surplus accounting. Dr. Belmonte doctoral research, along with 40 years of stock market experience and 18 years of actual portfolio implementation, found that with the change of just one statistic in the research methodology, the resulting returns were and still are among the best in the world. So thanks for being here. Enjoy this presentation we have for you today.
Well, hi everyone. Welcome to Buffett and Beyond Research, and today we're going over how to outperform any ETF, exchange traded fund, or mutual fund, or the S&P 500 based on clean surplus finance. And this lecture is developed by myself, Dr. Joseph Belmonte, based on the book Buffett and Beyond, second edition, published by Wiley Publishing. So folks, let's get right into it. And remember, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest better than Warren Buffett. Now, most ETFs are constructed to mimic an industry or an index. Thus, these ETFs contain both the above-average performing stocks and the below-average performing stocks in that industry or index. In order to outperform an ETF, we should buy the best performing above average stocks in that index and leave the below average stocks for someone else to buy. And the reasoning is, why buy the below average stocks to put in your portfolio if you want to outperform that ETF or that index or the S&P 500 for that matter? So the very most important question then becomes, how do we select the best performing stocks in that index? Yeah, folks, welcome to the holy grail of investing, but it takes work. The answer is to use the Buffett and Beyond stock selection method based on clean surplus finance. But before we get into a host of ETFs, let's go over this a little bit, because we first must discuss the methodology and the above market returns using the Buffett and Beyond stock selection method called clean surplus. Now, clean means cleaning up owner's equity or book value and cleaning up the earnings and profits. And surplus means the earnings or the profits. So we have to clean up those earnings. And I'll show you what we mean as we go along. Now, what is clean surplus? Warren Buffett used the clean surplus model as a filter to determine the operating efficiency of a stock and to compare to other stocks. Now, this comes directly from Buffettology by Mary Buffett, who's Buffett's former daughter-in-law, and that's a very good book if you understand numbers. My book, Buffett and Beyond, goes beyond Buffettology and tells you how to get those numbers and starts from A, B, C. So if you don't even know how to spell accounting or finance, you can understand my book and read my book before you get to Buffettology. But if you read my book, you won't need to read Buffettology. Now, we use clean surplus solely as a stock selection method. And in order to do that, we have to change just one number from Buffett's method in order to be true to the clean surplus research, because this research comes from the finance research. And folks, it's relatively new. 1989 out of Columbia University was the first published research paper. All right, now clean surplus allows us to generate returns greater than the S&P 500 index without taking on more than market risk. You see, folks, you can hear a lot of claims out there about particular method outperforming the S&P or outperforming this index or that index. But the next question you have to ask is, what is the risk you're taking? So when able to outperform the S&P 500 without taking on more risk than the S&P 500, now you're doing something, and that's what we're going to show you here today. Now, these are the returns since December 2002. So this is pretty good, folks. Simple yearly returns we've been returning in our model portfolio and real life portfolio 15.5% per year versus the S&P 500 index of 9.5%. Now, folks, this is a 63% greater return. In other words, 15.5% is 63% greater than 9.5%. Now, on a compounded basis, in other words, had you left money in that account since December 2002, the S&P would be up 310%, where our 30 stock portfolio, our growth portfolio, would be up 862%. Folks, that's almost 3 times the market averages, which is probably one of the best strategies out there, or one of the best performances out there. Now, our model portfolio that we're talking about here is based on buy and hold, with changes, if any, taking place on the last trading day of the year. And most stocks are in the S&P 500 index. So change it once a year, and then you go to the beach for the next year and leave the portfolio alone. Remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And just to lend credibility to what we're doing, Buffett and Beyond is registered with the National Association of State Boards of Accountancy as a quality assurance service sponsor of continuing professional education credits. That's what the accounting profession thinks of clean surplus. And we're approved by the state of Florida to give this seminar, or give a 2-hour seminar, to CPAs, certified public accountants, throughout the state of Florida. And just to introduce myself, I have a Doctor of Business and Finance from Nova South University. And just to let you know, I went back to school in midlife in order to strictly study the stock market. I was an engineer, a marine engineer, and I rose to the position of chief engineer, and then I went into the finance business. And when I found out that I could not outperform the S&P 500, I said, let me go do some serious research and find out how I can. That's why I went back to school. My MBA is from Florida Atlantic University, and I was a former associate professor of finance at Northwood University. What's our goal? Well, we want to be able to outperform any index or industry-related ETF. And out of that index or industry, we want to be able to select the stocks that are growing the fastest and the most consistently. Now, remember, 96% of professional money managers, and by professional money managers, we mean those folks who run the exchange-traded mutual funds and ETFs, because we can follow those. But over any 10-year period, 96% of professional money managers cannot outperform the S&P. And folks, that is our goal, and we have been doing it for the past 18 years. How do we outperform the S&P 500? How do we outperform those ETFs? Well, we use a model that allows us to compare and thus select stocks that are growing the fastest and most consistently. Mostly large cap stocks. In fact, our portfolios are made up of all large cap stocks over the past 6 or 7 or 8 years. And we want companies that make the most efficient use of our invested dollar. And these are the companies whose stocks will appreciate faster than the market averages and associated ETFs. And it just makes sense. The most efficient companies out there are going to make the most amount of money, and thus the stock price will reflect that. All right, what is this model? What is this model called clean surplus finance? And the question is, does it really work? And these are the portfolio results that I showed you before, that compounded returns over the past 18 years, 862% versus the S&P 500 index of 310%. What is clean surplus? It is a finance methodology used to measure efficiency, predictability, and comparability among different companies in different industries. Now, the income statement doesn't do it, and I'm talking about the accounting income statement, and the balance sheet doesn't do it. And thus, the accounting community was searching for a return on equity that is comparable. How do we know the accounting statements don't allow for efficiency, predictability, and comparability? Because if they did, then all the accounting professors, all the finance professors, and all the professionals who come from these disciplines would be able to outperform the market averages. And guess what, folks? They can't do it. Remember, 96% of those professionals over a 10-year period cannot outperform the S&P 500 index. Who teaches investment analysis in our colleges and universities? The accounting professors and the finance professors, none of whom can outperform the averages. They teach us the numbers that are unique, not comparable to individual companies. What does that mean? We'll show you. The accounting numbers are used for internal control. They must account account for everything, and we demand this. They were never meant to be used to compare one company to another. However, these are the only numbers we have, and analysts use them. Now, accounting is different than finance, is different than investing. Down here, finance and accounting for Corporation A go over all the numbers within that corporation, and many of those numbers are unique to that corporation. Many of the expenses are unique to that corporation. And if they're unique to Corporation A than they are from Corporation B, you cannot compare them. So finance was designed to work within the corporation, accounting was designed to work within the corporation, and those numbers are used to compare the results of Corporation A last year, the year before. So in other words, time series analysis within that corporation. Now, Corporation B, finance, accounting are used to determine the numbers and the efficiency of operation within that corporation. But Corporation B has items that are unique to Corporation B, not comparable to Corporation A. What's investing all about? Investing is all about you, Mr. Money Manager, or you, Mr. Investing, figuring out which corporation, A or B, should be in your portfolio. You don't have to do all the stuff that the finance and the accounting folks do in the within the corporations, because Corporation A and Corporation B are not comparable when you use the finance numbers and the accounting numbers. Now remember, I give this seminar to CPAs all throughout the state of Florida, and they are very surprised when they learn this, and they all agree with it. Now, accounting is different than finance, which is different than investing. So clean surplus earnings are different than accounting earnings, because with accounting earnings, you must deduct non-recurring items, in other words, one-time sale of a piece of property, and you may be a computer company and you sell a piece of property that you started your office in. Well, that is not operations of your core business. That is a non-recurring item. And also future liabilities. Let's say a lawsuit is the most common future liability out there. So clean surplus earnings use accounting earnings, and they take away the non-recurring items and the future liabilities. Yeah, you all what? Yeah, and you have to go to the accounting statements year after year and find those non-recurring items and future liabilities and take them away from accounting earnings. Not easy, folks. And just as a side note, it took 23 of us 8 months to develop the numbers for the S&P 500. 23 people, 8 months. That's how long it takes to develop this. But of course, we have a computer database at this point, so it's going to be a lot easier for you than it was for me when I started this. Okay, let's look at Bank A and Bank B. Let's start down here in year one. Let's say you put $100 in the bank, and that year you make $10 worth of interest. And let's say you don't take any money out. So you put that $10, or you keep that $10 back in the bank, and year two, you're starting out that year with $110. The 100 you started with and the $10 you made. Let's say that year you earned interest of $11. You're retaining the whole 11. In other words, you didn't take any money out. You're keeping it in. The third year, you have $121. You see where we're going with this. And by the way, folks, this bank account example is pure clean surplus finance, pure clean surplus accounting. Now, in any one year, you take the amount that you made. Let's go up here to year 5. Take the amount you made, divide it by the amount of money you started that year with, and that gives you a return on your equity, and over here it's 10%. So you take the return on equity for each year, and we see with bank account A, it is 10% per year. All right, let's go to bank account B down the street. You put $100 in year one, you make $10, you're retaining the whole $10. The next year you start out with $110. That year you make $10, you're retaining the whole $10, put it back in the bank or keep it in the bank, and the third year you start out with $120. So you take the amount of money you made in any one year. Let's go to year 5 here. Take that $11, divide it by your equity of $142, and it gives you 8%. Well, we take the time series of each year, the time series of the ROE for each year. ROE is return on equity. And we can see we have 10% and went down to 9% and down to 8%. All right, let's compare banks. Now, bank account A, we have an ROE of 10%. It was very consistent. Bank account B, we have an ROE of 8% in the fifth year. So let's go to this question. Why did we earn more interest in year 5 than in previous years? Well, we had a larger equity base. Now, why did we have a higher equity base in year 5 than in previous years? Because we kept retaining all the interest that we made. Let's go to the next slide, which is very, very important. Now, if you were able to purchase one of these accounts, this is the mind-blowing question, folks. If you were able to purchase one of these accounts, which account would you be required to pay more for? Yeah, bank account A, because it has $146 in the bank. Why does it have $146 when bank account B doesn't? Because it's earning more interest. It has a higher ROE. See, now you're beginning to understand why some stocks have a greater value than others after 1, 2, 5, or 10 years, because they keep retaining most of that money they're making, and they build up their equity base, and the higher the equity base, the more money they can make in the future. All right, now, into which bank would you rather invest your hard-earned dollars? The one earning the most on equity, duh. And really, did you ever ask why one bank gave you a higher return than another bank? And the reason I'm asking this kind of silly question is, do you really need to know all about a company in order to make an investment decision? And what I'm saying, what Clean Surplus says, is no. All you have to do is know the numbers. And how do we know everybody uses the wrong return on equity? Because don't forget, in any one year, just 25% of professional money managers outperform the S&P 500. The following year, just 1/3 of that 25%, or 8.25%, can outperform the averages 2 years in a row. And over any 10-year period, as you know, 96% of professional money managers cannot outperform the averages on a risk-adjusted basis. And this was from Morningstar, June 2002. So the portfolio. Now, this is our portfolio and how we beat the S&P 500. It's made up mostly of large cap stocks. We pick 30 stocks a year with the highest clean surplus return on equity. We put equal amounts of money into each position, hold for the year, and then between Christmas and New Year, when the markets are slow, we replace stocks if need be, and then rebalance, and then we hold for the next year. It's that simple, folks. The complicated part and the most work comes from getting those numbers. But, folks, we do that for you. So you can change your portfolio at the end of the year, hold it for the year while you go to the beach, go play golf, go be with your loved ones. Folks, you worked hard for the money that you're investing in the stock market. Invest wisely. All right, the ROE tells us all about earnings. Let's go to MasterCard. And all we have to do is look at that clean surplus return on equity. All these other numbers, this is how are used to figure the clean surplus return on equity. So to get into our growth portfolio, for most stocks, we want to be able to see the stock that we invest in our portfolio, or that we put in our portfolio, to have ROEs 20% or greater. Remember, the average stock in the S&P 500, 13.5%. We want to see clean surplus return on equity of 20% or better. Now, MasterCard has had a 20% or better all these years. Now, for 2020, pandemic time, it only fell to 19.3%. Folks, I analyze hundreds, almost 1,000 stocks a year, and to see this drop only to 19.3%, this stock was doing very, very well. You should see some of the other stocks out there, and you might even have some, so you know the decline that took place. Now, let's see how MasterCard has performed. When we look at the past 5 years, black line is the S&P 500, up about 75%. MasterCard is up 250%. Let's go back. Because the average stock in the S&P 500 has a 13.5% ROE, MasterCard has a 20% or above ROE, clean surplus ROE, so it's twice as much as the S&P, and it outperforms the S&P over 5 years, 250% to 75%. Folks, that's a big deal. We look for a 10-year summary of clean surplus return on equity. We want a high return on equity and a consistent return on equity. Now, let's look at a summary of stocks we know and how they have performed. S&P 500, a 13% ROE. MasterCard and Visa above that return on equity of the average stock. Meanwhile, American Express, Capital One Financial, Hartford Financial all have ROEs below the average stock. We would expect MasterCard and Visa to outperform these other three stocks. Now look at the year. This is up to 2012. So the previous 5 years, MasterCard outperformed, Visa outperformed, black line the S&P 500, American Express performed equally well with the S&P 500, while Capital One and Hartford underperformed the S&P 500. Now, let's come up to 2020, and these are stocks that we talked about on the radio. And again, I don't have the S&P 500 in here. Master and Visa outperform, where American Express, Capital One, and Hartford are the bottom three out of these five stocks. Bring up to date, just as of the other day, black line S&P 500, Visa and MasterCard outperforming the S&P 500 by a long shot, and American Express almost keeping pace with the S&P 500, and Capital One and Hartford way underperforming the S&P 500. What have we learned here? We have learned that good stocks tend to remain good stocks for a long time, whereas average stocks or below average stocks tend to stay below average stocks for a very long time. And then when we look at some of the stocks that we have in our portfolio, you can see these high return on equity with Amazon, Apple, Bookings, which is the old Priceline, Facebook, Five Below, Illumina, all have ROEs very high, and these are in our 30 stock portfolio. And when we look at our 30 stock portfolio, and this is as just last week, the black line all the way down here is the S&P 500, and you can see that just about every stock we have in our 30 stock growth portfolio is outperforming the S&P 500. Folks, this is absolutely amazing. Now, I couldn't fit all 30 stocks on this chart. It would only take about 20 of them, but the 20 stocks that I have listed here are all outperforming the S&P 500. That's how our portfolios outperform. We pick the stocks with the highest clean surplus return on equity. Now, let's get to the ETFs. Now, these are the spider sector ETFs, so the S&P 500, and we have oil and gas, technology, utilities, semiconductor, consumer discretionary, etc. Now, we took all the stocks in each ETF, and some ETFs have over 100 stocks, folks, so this is a lot of work. We sorted from the highest ROE to the lowest ROEs. We then took the stocks with 20% or higher ROEs, just as we do with our 30 stock growth portfolio. And the stocks with the highest ROEs should outperform the stocks with the lowest ROEs, and thus our portfolios of ETFs, of the top stocks in the ETFs, should outperform that ETF. Now, let's take the semiconductor, a lot of numbers here, divided it into three parts. So the semiconductor ETF returned 166% over the past 5 years. We took all the stocks with higher clean surplus ROEs than 20% or 20% and higher. Those stocks, and we have 11 of them, out of the 33 stocks, returned 419%. And I'll show you a chart or a summary chart, next chart. And the average returns of the second group, 112%. The returns of the third group, 42%. Now, what does this mean? The semiconductor index returned, or the semiconductor ETF returned 166%. The top group, those top 11 stocks, returned 419%. Folks, this is a big difference. The middle group returned 112%, and the last group returned 42%. So if you're going to invest in stocks, don't you want the stocks that have the greatest chance of returning more than that ETF? And for those of you who are money managers out there, when you look at your clients, what are you using to differentiate yourself from the other money managers out there that are buying ETFs for their clients? You're not. You try to pick an ETF that's going to outperform another ETF, but why don't you invest in the stocks in that ETF that have the highest return on equity? And you can be pretty much assured you will outperform that ETF. There's the difference. There's the value added. There's the differentiation that you have over other money managers. And for you investors out there who invest in the ETFs, go the one step, look at the stocks that we say should outperform and buy those stocks instead of the entire ETF. Because if you're buying the semiconductor ETF, you're buying the good stocks, you're buying the average stocks, and you're buying the below average stock. Why do that? That's the question. Why do that? So when we look at all the ETFs that I showed you before, only 2 of them underperformed or had a negative return over the past 5 years. If you're a money manager, wouldn't you rather invest in the top stocks in this oil and gas ETF? Instead of losing 50% for you and your clients, you would have gained 14% over 5 years. That's not much, but folks, it's better than losing 50%. And you can see that each one of these ETFs, where we pick the top third of the stocks in that ETF using the clean surplus method, every ETF that we pick the top third, all of those portfolios outperformed. And again, you don't want to get into an ETF that's going to give you a negative return, because if it does, and you have no control over that, by the way, it's the economy. So you have no control over that, but at least you have a shot at of giving them a positive return over the following several years. So folks, wouldn't you rather see these type of returns rather than these type of returns? And you can do that. So we put them in descending order. This was our growth portfolio. It would have returned more than every ETF except the semiconductor ETF over that time. We returned 161% over 5 years. Semiconductor, 160%. 166%. All the others returned less than that. Now, the top third of the portfolios made up of those ETFs, we would have placed third, but look at these returns up there. And you have got to know how to select stocks in order to beat our growth portfolio. Now, here's what the S&P 500 index did over that 5-year period, up 57%. So, had you invested in the S&P 500 ETF, you would have been right in here. You would have outperformed some of these ETFs, but not all the ETFs. And folks, had you invested in the top stocks in those ETFs, you would have outperformed all, but you would have outperformed the S&P 500 index. Only 2 of those portfolios would not have outperformed the S&P 500 index. So, just for attending, you can have a free 4-week trial of our video newsletters going over each Saturday. We go over another stock and we compare it to an ETF, or we get it from an ETF and we compare it to the lower stocks in that ETF, the below average stocks, and see how the numbers compare. So you can have a free 4-week subscription to our computer program of our portfolios. Now, here's the book, Buffett and Beyond, folks. Go to Amazon, order the book for $25 or whatever it is. This will change your investing life. So, folks, with any subscription, once you order a subscription, you can get a free copy of The Men Who Moved Wall Street. And it has a very nice article on us and our methodology of clean surplus. So, folks, you can get your free issue with any subscription. And we have a subscription that everybody can afford. So remember, if you want to live on the beach like Jimmy Buffett, you have got to learn better than Warren Buffett. You have got to learn how to invest better than Warren Buffett. And with the clean surplus methodology, we give you all the tools that you need so that you can invest in your own portfolios and make more money than the market averages or the ETFs out there. Folks, thanks for attending. Hope to see you soon. And remember, you want to live on the beach like Jimmy Buffett, you've got to learn how to invest better than Warren Buffett.